Hey there, everybody. Good morning, good afternoon, good evening, depending on where you guys are at. Thanks, Mirza Duncan. Hi, Heather. Good to see ya. I hope you guys are all having a good trading day so far. Hey, Daniel. Good to see you as well. Hope you're doing good. Hey, Baby Bear. Earl. Great to see ya. So, for today, right? And thanks, Duncan, for doing that in the PRM. Appreciate it. Um, for today, hey, TV Rook. Great to see ya. I know. So, TV Rook is mentioning over on Twitch that today is a snooze fest, and guys, it certainly is, right? But we know to anticipate this. So, for those of you who are newer to trading or maybe have never traded around FOMC, basically the way that usually works from an intraday perspective is we go and we identify a top and bottom of our range pretty early on in the market. So usually you get consolidation more during the lunch hour after Europe's close. But on FOMC days, it usually happens well before that time of day. And so we had identify that range pretty early. We chop in that range. Usually it's a more narrow range going into the announcement itself. Then once the announcement first comes out, which is at 1 p.m. Central, you get a spike in volatility that happens in both directions, both up and down. And it's not too uncommon to kind of see like a slingshot move almost on the chart with the ticks. And then it pauses for a little bit or it kind of stays within that choppy but still a slightly wider volatile range until Powell opens his mouth. Because today is one of the days where Powell will jump on to answer reporters' questions and have that conference call. And because of that, that in turn usually causes a second spike in volatility as he's answering questions. And typically speaking, we start to move in some sort of trend going into the close that day. Now, I am personally looking for that trend to either be bullish or bearish. Sometimes, usually, this is a characteristic of a more bullish market when we have a Fed day like this. Sometimes it will still get that spike in volatility, but then ultimately end up trading in the same range that we had at the start of the day going into the close and basically chopping to where it's a non-event. But I'm not anticipating that to be the case this time because there are so many people looking at what could end up happening, right? To see whether or not one, I think most people are anticipating the 0.25 rate hike. I think that's kind of already priced into the market. But there's a lot of talk right now about whether or not we are actually going to get any sort of rate cuts later in the year. And so I think when Powell comes on the mic and that narrative kind of gets released to us, right? Whether or not they're anticipating cuts or if they're going to stay with the hikes because of inflation or try and meet in the middle, whatever that news is more than likely what's going to cause the bigger market reaction. And remember, as traders, we don't really care how like what he says, right? Certainly from an economic point of view, right? As an American, you certainly might care on what he's going to say. But from a trading perspective, you don't really care. But the only thing we mainly care about is the market reaction to whatever Powell and the Fed says. That, as traders, is what we care about. And so, for those of you who are maybe on in the free room or on the mastery a little bit earlier today, we did a little dual session, me and Joe, where we were talking about the different possibilities. And I mentioned I am certainly looking for a more trending market. I want to see us either go to the upside, break that weekly resistance of 4,200, or I want to see us fall down. And certainly, let me pull up the chart here so you guys can see a bigger picture of that. Um, but as we pull up the bigger time frames, right, we know up above us on a weekly perspective, we have a pretty big line of resistance between the 100 period simple, which is right around 4,200. 4,200, of course, is also a psychological level. There is a gap fill to the upside as well as to the downside. So I'll mention those numbers in a second because those could make good targets if we do get some volatility. And then, of course, that second resistance is the ATR trailing stop, which is at 4,260. So the question is, do we have enough strength and positive reaction from the market off of this announcement? And maybe it also takes Apple, right? Tomorrow, Apple has earnings, and it's not uncommon where you get the initial reaction off Fed today, but then you get the bigger reaction, right? The digestion of the news, and then you get that bigger reaction tomorrow on a Thursday. So between Apple earnings tomorrow, and then, of course, the bigger reaction to the Fed news, maybe that helps to turn the catalyst to finally break this resistance and move higher, or we continue to hold resistance and we get some sort of reversal back down. And then from there, if we do end up getting the reversal, my question, at least for the market, will be, is it just to move down into support or into 3,800, which has basically been the bottom of the range this year and has been the consolidated range that we've been stuck in really since about October, maybe arguably November of last year. That's kind of been the bottom of the range. The top of the range has been the 100 period simple at 40. And as on the weekly chart, it's pretty clear, right? We've just been chopping in between those levels. So if we do end up getting a pullback, do we pull back into that range and hold support? Or does that bigger quarterly analysis finally come into play, which is anticipating more selling this quarter and we start to break 3,800 and maybe go down to test the lows of last year or get that bigger move to the downside? So that is what I'm trying to be patient on. I do, of course, have some longer term out like June quarterly expiration bearish trades on that are still very small risk, very great profit potential. So if we do get the sell off, awesome. If we don't and it bounces up and starts to break weekly resistance, that's where I'll look to protect capital. Um, but that's outside of that, that's where the majority of my capital is at this point. Otherwise, I'm very flat for the most part in my accounts. I don't have much out there because I'm waiting to see if this will finally be the catalyst for a move. And I know for some of you guys who have been listening to me for a while, it almost sounds like a broken record, right? Like I'm like, maybe CPI will be the catalyst. Maybe the last Fed news will be the catalyst. And now we're on, May Fed news. So I think this one will actually be a bit more of a catalyst due to all eyes being on this event itself. Um, and basically people wanting to know whether or not we're actually going to get rate cuts this year or if that's just not in the books. Um, because the question is, of course, are they going to help out the banks and that whole situation with Silicon Valley Bank and FRC and kind of help prop those up a little bit more? Or are they going to stick looking more at the inflation data and things like that? Which, yes, it has come back some, but keep in mind when these reports have come out, we're not seeing negative numbers that inflation's actually decreasing. It's not increasing as much, but it is still increasing. And so the question, of course, is the Fed going to try and address that and keep at the rate hikes? Or are they going to try and do something to help out some of these banks that have started to get into trouble? So certainly be an interesting day. But until that event happens, please be mindful of your capital risk if you're doing any sort of trying to do any sort of intraday move, because usually the characteristic for today, and as you can see here, on the intraday charts is chop, and you're already getting some clues of that, right? On our smaller time frames, we see Bollinger Bands turning flat or coming together. We have our moving averages starting to converge. We're kind of right by support level 5-minute chart. At the 10-minute chart, we are at 41.15. That's kind of been a short-term price support level recently. You can see that on the hourly chart between yesterday and to today. Um, and then, of course, to the upside, if we bounce up, we kind of ran both into the 30 and the 100 period simple here and stalled at those levels. So it could be a small range of chop. Usually in the morning, what I do on days like these is I'll do some background work that I need to do for Simpler in particular, or, I start doing scans and look for setups, but I don't take any trades. I kind of just sit on my hands. It's a, good day to go walk the dog in the morning, take a step back from your computer, and then prepare yourself so that way around 1, when that announcement comes out, you're good to go for those more volatile swings and certainly trying to trade into the close today. So, as always, guys, if you have any questions at all around trading, whether it is around the Fed event today, whether it's around a specific indicator or a chart setup, please let me know and I will be happy to pull that up or answer it to the best of my ability. Certainly, with Apple coming out tomorrow, we could talk about an Apple earnings trade if y'all like. And then quickly, I did mention this. So, gap wise, on the daily chart, there are a few gaps that haven't filled yet. To the upside, that's 42.18. So that's right in between the 100 period simple and the ATR trailing stop from a weekly chart. So if we do end up bouncing up and finally starting to break 4,200, that could end up making target to the upside off of a volatile move higher. At the same time, if we start to sell off, we have a gap here at 40, 30, 59. We actually made it back here on March 29th going into March 30th. Very small gap, but still a valid gap. And that, of course, is right in line with the ATR trailing stop. So if we start to sell off, that could make for a target to the downside. Below that, we have a second gap. This one's a bit more obvious. We made that gap from the 28th into the 29th, right? So back to back gaps, basically. And that one was at 39.7920. So that would be a short term second target to the downside if we do, in fact, get some selling. And of course, for that target, we'll also need to break not only the ATR trailing stop as support, but the 100 period simple. And so those might be targets and levels to be mindful of depending on how we move. But outside of that, until the announcement, just I would anticipate chop at this point. So, and then Lincoln Park, yeah, I see. Let me write these down. So you're looking at Airbnb and Roku. We can take a look at those. Absolutely. And then, yeah, Earl, that's a good question. So let me answer Earl's question and then we'll go on to Airbnb and Roku. So Earl's asking comments on trading ES directly versus options on SPX, for example, credit spread. So on a day like today, you can trade the ES because of how that works and probably still be able to scalp some sort of profit. I would be very mindful about your stops. I would look to try and enter at support or resistance levels, right? And look for the quick scalp hit. But with futures trading, because of how the profit increases per the price, right? The connection between those two, you can still make some good money in a market like this. You just have to be very mindful of your entries as well as where your stops are and of course the risk that you're putting out there. On the option side of thing, it's a little bit harder to do something in this kind of narrow range in regards to prior to the Fed announcement. And the reason why is because, and I'll pull up the option chain here, but unfortunately, unlike futures, where you can just now, of course, there are options on the future side of thing, but if you're looking to do pure futures where you're just buying in at the market and then jumping in and out, that allows for a little bit more room and consistency to take profits in this kind of market and certainly before the Fed news. For those of you who were on this morning with Joe, you saw that he locked in a quick win doing his future style trading. But for the option side of thing, what ends up happening is the premiums usually stay in the options until the announcement occurs, which of course is good news for credit spreads because you have a higher premium. Usually you can get a bit further out of the money and get a better risk versus reward. But the downside is that theta decay is not really going to take effect until after the announcement itself, which means, like I said, it's like almost like playing an earnings trade where you're not likely to take a big profit, if a profit at all, prior to the announcement because of how the money keeps building into the options going into the news event. And then if you sit through the news event, you have to be okay losing 100% of that capital risk. Because let's say, for example, I put on a call credit spread, right? And I jump in here. There's a price level at 41.40. I really think we're not going to break above that today. for whatever reason, this is not a trade I would do, guys. Just please keep that in mind. But for educational purposes, let's say this is a really big line in the sand for me. I really don't think it's going to break it. Well, if we looked at this style trade yesterday on a 0-day expiration, we probably wouldn't have gotten this good of a premium this far out of the money, especially if we had the characteristic of a smaller choppy range day, right? It just that type of premium wouldn't be there. But the flip side to that is you have to be okay with that risk. So on something like this, it's about a $1.75 credit, a 325, 330 risk. So if all of a sudden when Powell talks or when that news is released, there's a positive market reaction to that announcement and we rip to the upside, you could very easily find this spread all of a sudden in the money and potentially be at a full loss for the trade idea. So even though you can get good premium prior to the news itself, it's not you just have to be okay with the risk if you're putting it on and for that trade to go against you. So usually when I look to trade around Fed news like this in particular, it's one of those times where I actually would lean more towards either debit vertical spreads, something where that risk versus reward looks a bit better. So instead of having a 70 profit potential and a 330 risk, instead I look to have about a 30 risk versus a 330 profit potential. That way, it's less capital that I'm managing if the trade goes against me, but if it moves in my favor, it's a much better risk versus reward scenario. And what I look to do typically is I'll look to play both sides, right? Because, like I said, there's typically a spike in volatility in both directions off of the initial release at one. So, by playing it both directions, sometimes you can take a profit on both sides and you can do it very quickly, but you can also set it up in a way where you don't have to be correct on the directional move, right? So if the market really acts positively, great, you have something to the upside. If the market reacts really negatively to the news, that's fine because you have something to the downside as well. Um, and normally, like last year, when we had more volatility in the market, right? When we zoom back and 100-point daily ranges were more the norm rather than how scarce they are this year. Uh, Usually I used a strategy called the compound butterfly strategy, where I would do a call and put side, but I would use two debit broken wing butterflies. And that typically worked out really well last year for us whenever we put those on. But in this case, I'm actually not doing that for this Fed news. And though I do think this could be the Fed news to cause some volatility, the reason why I'm not doing it is because we haven't it's been a bit of a struggle with that strategy this year. Meaning last year we put it on for CPI and inflation data, we did it off Fed news. Even when Powell was talking and it wasn't technically a Fed day, right? Even when he was like at a conference or something, it still could sometimes make a really great strategy to have out there and to profit from. But this year, CPI just hasn't given us those bigger moves and certainly not the bigger follow throughs that we've seen last year. And I would argue on Fed days, though sometimes we have, an actual day of volatility, it's very short lived, right? It's not that catalyst for a trending move that we saw happen last year off of those announcements. And so my caution with that is because it hasn't worked that well this year overall. It's been a bit more of a struggle to just get a small profit or to protect capital. That's why I'm not taking that trade idea this time. I'm just kind of sitting on my hands. And if I miss out on that big move, I miss out. I'm okay with that. I rather let the market kind of prove that that's the strategy that I want to pull out of my toolbox again and use than keep forcing a strategy that the market isn't calling for, right? It's like using a hammer when you need a saw and you're building a house. You don't just use the hammer to build. You're not going to get nice clean lines to be able to put together and build up a proper house, for example, versus when you need to saw, you use the table saw. So that's kind of why I'm sitting on my hands and waiting on that. If it ends up turning into a market, Earl, where let's say it's a non-event and I know I talked about this in here before and we were talking about it earlier some, but the one thing that could end up happening, which I'm not hoping for, but we have to remember as traders is certainly a possibility. We all, as much as we want to see something in the market, we don't tell the market what it's going to do, right? The market will eat our account alive. And that's how you fall into that dark side of trading and your emotions start running things. So instead, right, you have to still, even like with my quarterly analysis, for example, I have trades out there but they're very low risk. And that way, if the market tells me that signal is not going to follow through the same way it has in the past, I'm not blowing out my account by doing so. But it could be a situation like we saw back in 2015, 2016, which is here. And you can see what happened those 2 years is we were really flat. We had a few moves for a month or 2, right, of a little bit of volatility, but you can see for the majority of the year, it was flat and choppy, and even with those moves down, overall, still a pretty flat and choppy range in and of itself. And so even though we're trading at a high level, right, back then we were, like, in the 2,000 range for the S&P, and now we're in the 4,000 range. It could still very well be a year of chopping. You can see for the first part of this year, that's what it's looking like so far from last year into this year's. We're just in consolidation. And so if that's the case, if this news event maybe causes a day or 2 of volatility and then we just stall, well, that's okay, right? Because it's cluing us in that consolidation might be the name of the game for the year. And if that's the case, then absolutely things like credit spreads, iron flies, unbalanced butterflies, iron condors, trades like that benefit from both chop and potentially a directional move are certainly the tools that I'll be looking at in my toolbox to pull back out and trade this. Um, and from that situation to Earl, the thing about that is that's nice is from a futures perspective, right? When you're buying and just jumping in straight at the market, you still need a directional move to get profitable, right? You don't want things to remain flat. Otherwise, your trade is just flat. Whereas with credit spreads on the option side of things, as long as your short strike remains out of the money, you don't care if it remains flat. If you bought slightly out of the money, for example, like to go back to this 4140 idea, we're buying slightly out of the money and then let's say the market does bounce, but our line in the sand at 4140 holds, you don't care. As long as this is at or out of the money, the credit is yours. And so that's really the benefit in choppy markets of using that style of option strategy is you don't necessarily need the directional move to still make your daily profit or to still grow your account overall. But just be cautious about doing anything like that prior to the announcement, especially if it's a short dated trade. You just have to be okay with that risk that you have out there if you do. Just like an earnings trade, you have to be okay with that capital going out there. So yeah, Earl, not a problem. Happy to answer that. And then Lincoln Park, I haven't forgotten. Let's go on to Airbnb and Roku. And if we have time, for those of you who want to look at it, we can certainly talk about Apple and talk about an earnings trade idea around that. Let me write that down really quickly. There we go. So Airbnb up first. And you're short Airbnb and Roku. Okay, so let's take a look. Giving it a second to load, guys. Sorry, it's Thinkorswim is dragging just like the market this morning, clearly. There we go. So with Airbnb, oh, we do have earnings coming up. Okay. So that hasn't happened yet. It looks like earnings are the 9th. Let's see. The 9th after market. So here's the thing to be mindful about that. Lincoln Park is sometimes you'll get a run up into earnings. That's actually not uncommon. It happens a lot, especially in a bullish market. But as you can see, with all the consolidation that we've had this year, there are quite a few symbols that are just consolidating. into earnings, where they're not really moving higher and they're not really moving lower. The good news is if you're short Airbnb, it does look like we're right up at a technical resistance of the ATR trailing stop. And we're also at a price resistance level. You can kind of see the Bollinger Bands are still flat currently. So at the moment, they're not anticipating a break or move higher prior to the news. And of course, if we do drop down, we have room to move back down into price support, which I would argue is around 112, followed by the 100 period simple at 110.60. The downside is you're likely to stay in chop going into the news event. And so if I don't know, what expiration your trade is or anything like that, but if you have a short dated trade and you decide to hold through earnings, it's the same thing like we just talked about with credit spreads through the Fed announcement. You have to be okay with 100% of your capital risk. And if you're not, then that's a good sign that you should probably look to protect capital, or maybe if you really want to keep the directional trade, reduce it and still have that trade idea out there that has a valid profit potential to it still. But yeah, I know, and I hate to tell you that chop is the name of the game, Lincoln Park, but you can see it clearly here on the indicators, right? The 10 and 30 are converged, the Bollinger Bands are flat. Momentum's just now starting to cross above the zero line, but you can see that we really have to zoom in to even look at the bars. So that's a sign of consolidation. Our bullish signal is trying to cancel out today. If it cancels out, that's going back into a consolidating signal. And you have a squeeze building up, but it's likely, given everything else and with earnings coming up, that it's not going to fire until earnings. And that's only if earnings is a catalyst for a bigger move. Sometimes, right, earnings are a non event. So let's see, last earnings, you had to drop up. The earnings prior to that, you had to spike down. Here, earnings kind of stayed in the same range short term, but it stayed with the trend higher ultimately. And then off this earnings, it looks like we chopped a bit, but then really started to fall not too long after it. So a mixed bag on how the market, at least compared to the last four earnings, reacts to this news. Um, and so, yeah, I hate to say it because I am right there with you. I do not want any more consolidation if I can help it. Uh, but that, like I said, you're not the one that's going to talk the market into trading unless you're Warren Buffett with that kind of size account. We're not influencing the market whatsoever, right? Our trade that we put out there is not going to cause a strong bounce up, a strong bounce down. So if that's the case, we have to play what the technicals are telling us, which right now and Airbnb, it's likely going to chop going into that news. It may move some off of the Fed event, right? If the market really does start to get hit with volatility one way or the other, that could affect names like Airbnb. Um, but with earnings, it could be a case of where it's a bit more muted of a move, or it may just ignore that and wait for the announcement before it decides to get that bigger move. That's certainly a possibility. And then moving on to Roku. I think Roku had earnings, but we'll find out in a second as soon as it loads. But if Roku's already had earnings, which it did, I thought it did. Okay, so had its earnings announcement. You can see overall it had a little bit of a dip lower, but was a bit more of a non-event, right? It didn't really get a strong gap and trending move. And so if you're bearish on this, right? So far it doesn't look bad. It's broken below the 100 period simple, which is a pretty strong line of defense for most symbols. But you do have the ATR trailing stop. So ideally, for your trade idea, whatever that is, if, as long as it's a bearish narrative, you really want to see a break in the ATR trailing stop. And if you get that, well, there's still room on momentum to go to the downside. The squeeze is still in the process of firing lower. So that might give it the strength to kind of break that support level. Um, but that's kind of the level that you need to see break. The caution I would say here is outside of course, you already being at support. If you go back, you can also see that this is kind of a price support level because this is on the last earnings announcement where we pulled back, stalled into before we had that spike higher. And so this one I would say is a little bit more um, sus- it could be influenced a little bit more by the Fed news, right? It could, if the Fed news is positive, this would likely follow the market a little bit more for bounce to the upside, or vice versa. If the Fed news is negative to the market, this could help with the catalyst of breaking this and dropping it down lower. So, any short term trade that you hold and there's not earnings coming up, still have to be mindful of that risk around the announcement. That's part of the reason why I'm pretty flat for the most part. And the majority of my short term trades, I think I have like one or two out there at most, but otherwise, I'm pretty flat going into this announcement because I'm waiting to see how the market reacts to things before either jumping into something from an intraday perspective later in the day after that news comes out, or right from a swing perspective, giving it today, maybe even into tomorrow, so that the digestion of that news can kind of help determine which way things want to go. Because don't forget, guys, sometimes on these Fed announcements, and last year makes a pretty like cleaner picture of this. But we've seen times where the market's initial reaction is a huge bounce to the upside, right? The day of the announcement. And then overnight, it's like the market kind of digests the news, right? It's kind of like having like some bad Tex-Mex, right? Or bad Indian food where it tastes really good when you're eating it, but then it kind of hurts the body the next day and you're like, "Oh, that was not the way to go about doing things." And it reacts negatively. So here actually, it's just right on the cusp, but this I remember very clearly. This was a Fed day last year, May 4th, right? It's actually the same one that we're prepping for this year, right? Same time last year, where the market's initial reaction was a huge bounce to the upside. We had a 158-point range higher that day. And then what happened the following day? Well, the market kind of took that news, digested it as like, actually, this, whatever they said, we thought sounded good, but it really doesn't sound good anymore. And so we gapped a little bit lower and moved 164 points in range to the downside. And ultimately, the trend following that continued lower. So that's what I mean by usually around the Fed news, we'll have some volatility the day of, but we also want to look out for tomorrow and see how the market continues to react the next day. Because sometimes it causes a reversal, and other times it will keep whatever trend move is going. And then, of course, with those trend moves, we'll also want to be aware of our levels. Can it actually break and get a move going somewhere, right? Can our daily squeeze start to fire? Maybe finally that weekly squeeze really starts to fire. Or are we gonna find ourselves still ultimately just in chop? And apps, I agree, I love Indian food. I was a big fan of that when I first lived in England was the first time I had Indian food, and it was amazing. But you never know, right? Sometimes those restaurants, you get, like, food poisoning or something, you get the idea. And, Anish, doc you? Yeah, let's take a look at that. Add that to the list. Split up here. Also a big fan of Tex-Mex, obviously. It's like a sin not to be a fan of Tex-Mex and be born in Texas. So, DocU also had earnings not too long ago, huge gap to the downside, right? So that was very much a trend move. Tried to bounce back up and maintain the 100 period simple, but ultimately that ended up failing. And now we've gone more into a bearish trend. The momentum still actually has room to move to the downside based off the bottom of exhaustion that we found last year. But when we zoom in here, right, we can see that this current range that we're hitting has been a place where the price has kind of seen exhaustion before. So I would be a little cautious of that. There's still room to the downside, but we've seen where momentum has stalled before at this level. So just be mindful of that. That being said, the compound breakout tool is still bearish. Yesterday, or not, well, technically yesterday or the day before, right? Monday or Tuesday, was a good place to maybe jump back into a short because we went up, tested the 10, didn't even break above it, failed, and we're rolling down off of that level, trying to make a new low. We'll see if it can actually close below this 48 kind of price level. Bollinger Bands are still pointed to the downside. So everything looks good about this lower. Let's make sure we're not running into a weekly support. I know, Alberto, I'm like starving over here. And then Chad, absolutely. Let's take a look at ORCL. We'll take a look at that next, followed by on. And then I still want to look at an Apple earnings trade with y'all. So mind you, maybe we shouldn't look at an Apple earnings trade just because the market might change where the price is compared to where Apple's going to be trading at tomorrow, but we can still take a look. So on the weekly chart, we're not at any sort of technical support level. Um, but 40, right around 40, I'd be mindful of. That's kind of been the bottom of this choppy range here and the lows of last year. So if we get down into that level and it stalls and it's holding, just be aware that we're kind of potentially in overall chop, I would say. Things look good for this to potentially break and move lower, but we had quite a bit of selling that happened last year. And so when things start to really turn flat like this, it one allows momentum to reset, which we've seen usually builds up energy into a squeeze, which we also have now. And then, of course, the question will remain if it can maintain. That's sometimes where that reversal back to the upside comes from. But I will say the overall, this weekly chart still looks pretty weak. The 10's trying to cross below the 30, that will form a bearish formation. Momentum starting to cross below the zero line, that's also bearish. Um, yeah, we'll absolutely look at Apple to Kudo. And then, of course, we have the squeeze and the Bollinger Band starting to open up some. So I'd say there's still a bit of room to the downside if we can, stay below 48 today, but be cautious around the 40 price level. Before we get to Apple, though, let's look at ORCL. Pull that one up. Nice thing about our Wednesday sessions is we have a full hour, so you usually have time to get through what everybody wants to look at. So an ORCL, oh, great squeeze. Chad, I get why you're eyeing this. Beautiful squeeze. Momentum was at exhaustion. That's been resetting. While momentum's resetting, all we've seen is consolidation. So it's not getting any sort of strong pullback with the price. Still have consolidation on the compound breakout tool. So that matches with the current chart pattern with the Bollinger Bands being flat. The overall trend is still bullish. So the only caution I would have here looking at this from a daily perspective is normally I would say, let's buy in and play this up towards 100. But we want to make sure that we're not at weekly exhaustion because weekly exhaustion is sometimes the clue that we could actually get a counter trend squeeze to reverse us back down. So let's pull that up and make sure that's not what we're seeing. Oh, and we're close. So that's the one thing I'm not a fan of. Technically, everything about this is still bullish. Our weekly squeeze that we were in for a couple weeks back here has started to fire, which has helped with this run up. Um, but we're very close to exit levels. So I'm not necessarily a fan of that. Bollinger Bands look like they could be starting to flatten out some. We do have a valid bullish divergent bar last week. So that's looking for a potential move back up to or above 9608 within the next 3 weeks, including the week that we're in. Um, Maybe if the Fed news causes that catalyst higher, there is a little bit more room and momentum here. So that could help try and get it closer to 100. Uh, but yeah, I'd be a little cautious of that one. If it was down here with the momentum bars, or certainly if it was at the zero line, I would be right there with you and looking for a short-term swing trade idea, Chad, to play that higher. And certainly, if you do have more bearish trades in your account right now, you might consider putting that in your account to kind of help even out the bearish and bullish sentiment. That way, if the Fed does cause the market to pop, that For things like Oracle that are setting up, that could be the catalyst for that squeeze to fire and move higher. Um, but I would definitely keep it low risk just because of where that momentum is at on the weekly. And you were looking at a broken wing with a 98 pin a month out. Let's take a look. How wide of a spread were you looking at for that? Pull up the positions page here. There we go. So about a month out, just a two wide. Okay. So maybe something like this. I don't think that necessarily looks bad. Usually when it's priced this cheap, if you will, right? With $1 strike increments. Um, Normally would lean more towards a vertical spread. Just because I think you can get a bigger bang for your buck on risk versus reward, or certainly if you don't mind the capital risk of just holding a long out there, doing a long, because with the squeeze, if it does end up firing and giving you that stronger volatile move, um, that in itself, right, could help you not limit your profit potential. Whereas with a debit broken wing butterfly, though it's a great strategy to help keep risk low, like this, for example, the downside is if, let's say, we start to break above 100, right? This is a strong move and we move higher, your profit potential gets limited down to 56 cents, which I mean, based off 44 cents is still over 100% return. Um, but it kind of, it limits that a little bit more. So I would probably lean more towards a vertical spread myself to still keep that risk low, but not limit the profit potential to the upside. And then if we did get a spike, you could always profit recycle into a butterfly or into a broken wing butterfly and then have a fun bonus trade out there, right around $100. Because ultimately, if this does fire to the upside, that for me would be my bigger target higher. Certainly, I guess the recent highs you'd want to be mindful of right around 97. But outside of that, 100 would be the big level to try and play into. And so, if we get up to 100 and stall because of that psychological level, and because that's not too far away from the recent highs that we've seen in docu in general, from a weekly perspective, that could make a really great place for a standard butterfly. So just just some thoughts there. And then after Oracle was on, so we'll take a look at that and then we'll look at Apple. Yeah, chat, of course. Always happy to help out. But I do like I mean, I don't think that looks bad given if you want to give yourself that time and keeping that risk smaller because of the Fed news if you're trying to jump in prior to the announcement. I think that's a pretty good chart overall. Just minus the weekly exhaustion is the only thing I'd be a little cautious of is it's getting close to that top of the axis. So for on, here we had a nice gap up on earnings, but we went right into technical resistance levels of the ATR trailing stop. That's starting to hold. Momentum is resetting towards the zero line. So that can happen with a bounce up like this or just through overall consolidation. It looks like we're building back into a squeeze. If we do manage to break above the ATR trailing stop, my next target would be this price level up here around 82, 83. And then if we manage to break that up into the recent highs of this year around 87, would make another good target to the upside. But the caution here, of course, is unless once again the Fed can really cause something to get a strong, more bigger move to the upside off of volatility and it brings some of these more individual companies up with it, right? Because they're following the market. I am not a fan of this being flat with the Bollinger Bands right now. We made a bearish divergent bar yesterday, holding the ATR trailing stop. And so far this morning, we're struggling to break above it. So that leans towards the possibility short term that we pull back down here towards 78, 77. If not, potentially reverse back down into either the 110 as a bigger support level, which is right by 75 as a mini psychological level, or potentially filling this gap and retesting the bottom here. Given the lower indicators, it looks like this is still going to be kind of stuck in chop, unfortunately, unless, like I said, we get a bigger catalyst off the news. From a weekly perspective, so from a week perspective, very overall bullish trend that it's been in. The recent pullback actually made a great bullish divergent bar, held the 30 period simple into the close of that bar. So that was an excellent follow through on a higher high, given that signal. But you can even see here, right, that this has just kind of been a pretty choppy range. And outside this blip lower that we had, uh, for the most part, around 72 to 74 has been kind of a price support. And right around here from 83 to 85 has kind of been a price resistance. And so that's once again the caution is we're getting close to price resistance. And for those of you who have been following along with me for a while, y'all know one of my rules is as clean as everything else on the indicators can look for, let's say, a bullish sentiment in this case. If you're at price resistance, I personally wait. I either wait for a confirmation that we're breaking price resistance, or I wait to see if price resistance holds and it gives me a pullback. And if that pullback, everything still looks good, then that's the better entry to take. Because I've personally been burned one too many times looking at something and everything could be great across the board. And I would say here it is actually showing still more chop. But if it, let's say, had the bullish momentum, the bullish actually right here is a really great example. So here last year, we had bullish momentum building up, bullish signal on the compound breakout tool. We had a squeeze and bullish trend, right? All of that looked good for a move higher. Even on this bar here, the Bollinger Bands looked like they were starting to open up. So all of that looked good for maybe a continuation of the trend higher. But what happened? Well, we actually got stuck at price resistance. And price resistance, as you can see, won over everything else. And we had to sit through another pullback before it actually was able to break that level. So instead of jumping in at this level and then having to sit through pain of a pullback, or if it's a short data trade, right, taking the loss and then having to sit with that loss in my account before jumping back in, I rather just look for the pullback into support. And then when support holds, I know this makes for good first target. And if we start to break that, then I can play for the bigger trend move. So that is kind of what this looks like to me right now. The weekly Bollinger Bands are relatively flat. Momentum is actually still in the process of resetting, so we don't have any green bars yet helping us out. Our pullback signals attempting to cancel out this week, so we'll see on Friday whether or not it does. If it does, that helps the bullish sentiment, but it's still actually, with only one box canceling it out, leans still more towards a consolidating signal. Um, and so from a weekly perspective, I actually like the chart overall. It's just not necessarily the place I'd want to jump in at given that price resistance there. So I hope that helps to your apps. And let's go on to Apple now. And really quickly, for those of you trading the S&P, right? Here's a really good example of where we dropped down, started to identify a potential bottom of a range for this morning, bounced up, went right towards the 100. We're holding that as resistance and we're kind of falling back down again. So we're just overall in a choppy, narrow range, which just unfortunately is the personality of a morning prior to a Fed news event. So on Apple here, Apple, we have earnings tomorrow aftermarket, right? Yeah, aftermarket close. Let's see, on prior earnings here, we had a nice gap up. The following day really trended higher and then consolidated. The thing to be mindful of with Apple, though, for this earnings trade I'm about to look at is the news comes out on a Thursday after market. So, really, the only thing that we want to look at here in regards to a short term earnings lotto style trade is the next day, right? Because if we go with this week's expiration, we'll only have Friday to go into the trade with. So it won't really matter the trend move that follows the event All we're looking is for that next day reaction. So in this case, the next day reaction was a gap up and a little bit of a move higher. Here, off of this one, from the close into the open, we had a gap up and then a pretty strong trend to the upside that day. So that was a bit more of a volatile move. Here on this Apple news event, we had a gap up from the close and then it stayed higher for the majority of the day, right? It didn't come back down to fill the gap. So leaning towards the volatile side. So let's go. Actually take this back a little bit further. Let me pull up a 2-year time frame. Take a look at a few more earnings, but for the most part, at least the recent earnings, we've been more on the volatile side. So usually on earnings lotto trades like this, I'll either consider an iron fly to take advantage of the premium crush that happens after the announcement if I think it's going to be a non-event, or I look to play the volatility, right, for a potential gap move. And like I said, the last 3 out of 4 have leaned towards the gap. Let's take a look at a few more here. So that was a gap move here off this earnings from the close of it into the open. That was a gap and run higher the next day. Here from the close to the open, that was a gap up and then it ran higher overall. This one was actually, let me pull it back a bit more. So this one was actually kind of a flat open, but then it trended higher the day of. And then this one was a slight gap lower, went up to test the close of the range. Um, but for the majority of that intraday move, right, it trended lower. So given how the more recent earnings have acted, and of course with the Fed news, if you for whatever reason wanted to put this on prior to potentially play off the volatility around the Fed announcement itself, I'd probably lean towards the volatile trade idea. So now that we have that analysis from the chart and our technicals, let's go ahead and pull up the option chain. And our option chain here, we go with it May 2nd, right? This week's expiration. And the anticipated range, which of course encompasses the Fed news, it encompasses the earnings of it, is about a $5 move. So from that perspective, the market is anticipating around a 550 move up or down for the remainder of the week. And we're trading basically right at 170, just a little shy of that. So normally what I would look to do if I wanted a consolidating trade, like I said, is go with a iron fly, which I'd price out something like this, right? It's still about a 395 credit, a 105 risk, not a bad risk versus reward. And the idea is if it's a non-event or if into the close on Friday, we kind of drop back down into this range or bounce back up into this range, depending on the initial reaction. The theta decay is really going to work in your favor and it allows for a nice profit. And like I said, it's not a bad risk versus reward. But as we've seen, the technicals, at least recently, off of Apple News events, have seen a bit more of a gap move. So usually I would look at a debit broken wing style butterfly. Unfortunately, given the anticipated range, I usually try and put my short strike within the anticipated range for the pin. But in this case, it's too close to the underlying price. So if we did do, let's say, a broken wing butterfly and just went slightly outside of that for the pin, the call side's costing about a 111. But remember, we want to do both the call and put side because all we're betting on is volatility. I have no insider information on Apple, so I have no idea if the market's going to react positively or negatively. All I'm anticipating is that there's going to be a volatile move. So if there's a volatile move, that means I also want something on the put side, right? And I can already tell you right now at $1.11, likely this is going to cost about the same. And that means it's going to be, if I want to encompass the 65 level, yeah, it's about $1. So it's about a $2 cost basis. On a 2.5 with broken wing butterfly, there's no way I would put on this strategy for a $2 cost basis, because what that means is though the max profit potential is still about 3 if you get a pin on one side or the other, if it's a stronger move and it goes completely in the money, you're only allowing yourself maybe a 50 cent profit because it will settle for 250 if it goes completely in the money. And so that, from my perspective on risk versus reward, that just doesn't make sense. So let's see what a vertical spread looks like. Yeah, even that, a 2.5 with vertical, 67 cost basis versus 82. So they're really keeping the premiums in this today. Which once again, it makes sense. We don't have the earnings announcement yet, so premiums usually build into that. But then, of course, we also have the Fed news today, so it's kind of like double up here on Apple from a premium perspective. Um, if you really think it's going to be bigger than a 5 point move, you could arguably just go with two longs and do like a strangle with a long call and long put. Um, if that's within your risk tolerance and you think it's going to be a bigger move, by all means, go for it. But I actually wanted to try and trade Apple earnings, but given how expensive this is, I will probably sit on my hands on this quarter for this earnings announcement. Uh, I mean, that's at least a bit better of a risk versus reward. So if you go right at $5 with the idea that will exceed the 5 point range a little bit, that a 2.5 with spread on each side is about $1.13 cost basis, $1.37 profit potential. So the risk versus reward at least looks a bit better in that sense and still stays right around that first deviation move for the remainder of the week. Um, but yeah, keep in mind, you could look to open this now if you wanna look at scalping a quick profit, if you think the Fed news could end up causing a bigger move on Apple prior to the news event and do it that way. For myself personally, I would probably not put this on today. I would wait until tomorrow and probably the second half of the day tomorrow just to have a better idea of where the price is trading at. It still might be at 170 or, it might be up or down 5 points. But either way, I would probably wait, see if the Fed news helps bring down at least a little bit of those premiums. I doubt it's going to bring it down much because it will still be before earnings. But see if we just get a little bit of pullback on that premium to where you might be able to jump in for a better risk versus reward still within that anticipated range. So, bit more expensive on Apple for those premiums and how they're pricing it out, unfortunately. That is basically my time, guys. If you have a last minute question, I could probably answer one more or take a look at one more symbol before I have to go. But outside of that, just remember, please be mindful of your risk overall. And then let's see, there is one more question that came in. AZNC is asking, do you ever buy 100 shares and then sell a deep in the money call prior to earnings? I have not. So basically, you're looking at doing some sort of covered call. Um, and you could certainly do that. I haven't traded covered calls in a while. Um, keep in mind by selling in the money like that, you're either like, let's say we did it on Apple and then we went in the money at the 160 strike. You're either okay getting um with a pullback to where basically this premium expires and then you're down on your shares some if you're buying it at the same time because your shares are going to lose money from a pullback. But if this 160 strike all of a sudden bounces out of the money, all that premium will be a profit. Vice versa, if it continues higher, then you got to be okay getting called out on your shares. So I usually don't do that around earnings in general, but I'd have to take a look a little bit more closely at that to see if it makes sense for a on the risk versus reward narrative on the premium versus what you're buying the shares at. But yeah, sorry, I not my go-to strategy, I would say. I apologize, I can't help you out more on that. Let me pull up MVDA and that will be my last one there because I see a few of you guys asking about that. And then my top name for a long play, Rodney, I don't have any at the moment. I wish I did. because I'd probably be in it to help balance out my account a little bit. Things I've seen, either they've struggled to take off and they've just remained in chop, or we're at like weekly exhaustion, or it makes it kind of hard to try and do anything higher because I know that exhaustion on a longer time frame could cause us to either stay stuck in chop or cause a pullback. So I wish I had one to give y'all, but I am still actually doing scans myself trying to find something that I like to play for that more bullish bias. MVDA. Now, this has a really great squeeze. We do have some bullish sentiment here, but you can see once again, right? The struggle with this is we are still kind of in overall chop. It looked like it was going to start breaking higher here, but then immediately pulled back. If we do manage to close today with the bullish divergent bar off support, that might be a good place to consider at least a short swing trade. But last I checked on MVDA, this was one of those symbols where we're at weekly exhaustion. So let's double check. I might be wrong, but I thought we were at weekly exhaustion on this one. Waiting for it to, yeah. So this is the struggle, Rodney, that I'm running into because MVDA, I'd love to play to the upside. That one has looked solid all year for the most part, right? Beautiful run higher. But we're at exhaustion. We're already starting to get red bars. And that doesn't mean we couldn't technically adjust the axis and move higher, but it is a clue that the price could at least stall for a little bit or potentially get a pullback. And in line with that consolidation, we've had currently back to back divergent bars. And if we do print a bearish divergent bar for the week, that gives us the possibility of a lower low. But naturally, back to back divergent bars are a sign of chop. And so it could just remain in that chop narrative where, we consolidate, it continues to build energy into that daily squeeze, but it allows the weekly chart to get a bit better of a reset before it tries for the next leg higher in the bullish run. So I overall like MBDA, but this is a really tough spot for me to try and get long on it, knowing that we're at these exhaustion levels here. And then and I see Casey that came in. So this will be my last one, guys. SLV will be the last one. I saw that come in just now. And then I will have to sign off here and put the kiddos down for their nap. Let's pull up silver. I know gold's been doing overall well this year. Haven't looked at silver in a while though, so let's see how that's holding up. Of course. So silver, great run up recently. Consolidating though, right? That's allowing the daily momentum to reset. So here's a great example of what exhaustion looks like, how it's pulled back. The price doesn't always have to pull back with momentum when it's at bullish exhaustion. And same thing with bearish exhaustion, right? Sometimes all it needs to do is just chop. That allows momentum still to get the reset. The consolidating signal is still valid on the compound breakout tool, and we're building into that squeeze. Now, normally when I look at something like this, I'd be looking to try and take it higher, but especially with that high compression squeeze that's showing up on the daily chart, which is that orange yellow dot that you saw, high compression squeezes are sometimes a clue that you might get a counter trend squeeze. So the trend is naturally bullish on the daily chart, but that squeeze could actually fire it down. And usually when I see that, I'll look for weekly exhaustion. And so we're definitely not at the top of the axis. We can see that's way up here. So there is plenty of room for momentum to continue. This is still a bullish signal, but we have seen at this price level before exhaustion occur and it pulled back. So that'd be my slight caution. Um, But yeah, most everything else looks pretty solid on that to the upside. The other caution I would say is we are at a price resistance level. So right around 24, we've seen the price stall back here and back here. So that might 24 to 25 might be a little bit of trouble to get above. And if we do manage to break above it, my next target to the upside would probably just be up to 2642, maybe up into the 2750 range as targets higher. Um, but there is room for this one. So that is my time, guys. Thank you so much for joining me. As always, may the trade be with you, my fellow Jedis. Be mindful of Darth Vader, aka Pal, coming on the mic later today. Understand the volatility that can occur there. So be cautious of your risk. And I look forward to talking to y'all next time. Bye.